Hello everyone. So now let's start our next chapter on the topic of measures of financial risk. Let's discuss the learning outcome first. So in this chapter we'll talk about the mean variance framework and its relation to the efficient frontier. We'll compare normal distribution with typical distribution of returns of risky financial assets, for example, equities. We will define the value at risk measure and would discuss its assumption, return distribution, holding periods, and would also discuss the limitations of value at risk model. We will explain and calculate expected shortfall and would have a comparison between expected shortfall and value at risk model. In the end, we will talk about the properties of coherent risk measure and will explain why VAR or value at risk is actually not a coherent risk measure while expected shortfall is. Now let's start our discussion with the revision of mean variance framework. This is something that we covered in our first book. So basically, whenever there is an investor who is investing in either the stock market or bond market, there's always a trade-off between risk and return. The trade-off means that if we want a higher return, we will have to bear a higher risk as well. As the term says that the greater the risk taking, the higher the expected return. So the higher the risk, the higher the return is basically applicable to the mean variance framework. So basically, if we have a standard deviation or risk here and if we have return here, it goes something like this. So basically, if we have a 5% return, the risk that we will be taking would be, let's say, 10%. But if we have to increase this return from 5% to 10%, we will have to take a higher risk of 18% as well. So the decision is that if the investor is happy with this 5% return, or if he is willing to take this additional 8% risk to be able to attain this 5% return. That's the trade-off that we are talking about. That's the decision which is taken by the investor as to what sort of risk he is willing to take while getting the desired return. Now, risk is often measured in terms of standard deviation, which is a variant of variance, and then we have return, which we compare with the risk to come up with the mean variance framework, or in other sense, the decision that we take while deciding the expected return in comparison to the risk that it holds. Now let's talk about combining two investments. So in the earlier graph, we had one investment only where we had one risk and one return. What if we have two investments, investment A and investment B? So basically, in portfolio management, there's not one investment. There are number of investment that goes in the portfolio. So the number varies from the size of the company, but it's definitely more than one or two investment. So if we have two investment, how do we calculate the mean and variance? So basically, the first formula which goes for the expected return, which is the mean return for the portfolio, we will be adding the returns and multiplying it by the weightage of the investment. So basically, if we have invested 40% in A and 60% in B, and if A is giving a return of 10% and B is giving a return of 20%, the average return would be more tilted towards the 20% because it has a higher weight. So basically, we would just multiply 40% into 10% plus 60% into 20%. Now if we increase this weight from 60% to 90% and decrease its weight from 40% to 10%, the mean would be very closer to 20% and vice versa. That's how we calculate expected return when we have two assets. The standard deviation would be defined as sigma p square is equal to w1 square into sigma 1 square, which is the standard deviation or the riskiness of asset A. Then we have w2 square into sigma 2 square, which is again the product of weighted square of asset B and its riskiness. And then we combine this as 2 w1 w2 sigma 1 sigma 2 into rho, where rho is actually the correlation between these two assets. So if the correlation is negative, which means that when asset A price increases, asset B price decreases, and when asset A price decreases, asset B price actually increases. So they move in opposite direction. So if the market is going up, A is going up but B is going down. So we are sort of having a net of impacts, and what we call it as hedging of these instruments. So when we have such a case where the correlation is negative, this number would turn out as negative, and this whole term would be subtracted from the overall standard deviation. But if the number is positive, if they move in the same direction, the riskiness would increase, and this whole portion would be multiplied by 2. It will have a double impact, and then it will be added to the base term. So if we have a negative correlation between the assets, that's more suited for us, and that's how we diversify our portfolio. Now let's discuss a short example. So we have a portfolio which has two stocks, stock X and stock Y. Stock X has a weight of 60% in the portfolio, and stock Y has a weight of 40%. Now stock X has an expected return or mean of 12% and a standard deviation or sigma of 16%. On the other hand, Y has an expected return of 20% and it has a standard deviation of 30%. The correlation between these two factors is 0.5. Now we have to calculate the expected return and the riskiness, which is sigma. So to start off, we discussed that expected RP, which is return of the portfolio, would be equal to W1 into R1 plus W2 into R2. So we have the weight for X, which is 60%. We will put it here, multiplied by its riskiness, which is the standard deviation, and then we'll take the weight of Y, which is 0.4 or 40%, and its standard deviation is 20. So the answer will be 15.2%. So as we noted that it remains between 12% and 20%. Now to come up with the portfolio variance calculation, we had this formula from the earlier slide where sigma p square is equal to w1 square, sigma 1 square, w2 square, sigma 2 square plus 2 w1, w2, sigma 1, sigma 2 into rho. So we'll insert the values here, the weight and the standard deviation for X, the weight and standard deviation for Y, X, Y, and then we have this correlation. So basically we have a positive sign here because the correlation is given as positive 0.5. So whatever factor we are getting here, this term is actually increasing this particular term. We will take a square root of it on both sides, and the resultant would be 18.74%. So as we noticed that the standard deviation remains between 16% and 30%. But since the weight percentage of X was higher, which was 60%, it remains closer to 16% rather than the 30%.